Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing GasLog stock and analyzing its financial ratios. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or support the channel, you can become a member by clicking on the link in the description below. GasLog is an oil and gas midstream company. Midstream refers to points in the oil production process that falls between upstream and downstream. Midstream activities include the storage, processing, and transportation of petroleum. Let's get started with the model. This is a really small company, 271 million market cap. It's a micro-cap company, and they're trading at $2.85, and they have 95 million shares outstanding. To calculate shares outstanding, it's market cap divided by stock price gives you shares outstanding. Let's look at the financials. Free cash flow is how you value a company. You estimate the future free cash flows and then discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Capital expenditures are property, plant, and equipment. And if a company has positive free cash flow, it makes it a lot easier for them to pay down debt, pay dividends, acquire other businesses, or invest back into their business to grow it. If a company has negative free cash flow, it might not be able to do any of those things. And this company has negative free cash flow in 3 of the 4 years. It does have positive in 2017. Net income is the profit and loss on the income statement. It's revenue minus expenses. Net income grows from 2016 to 2018, but then it goes to negative in 2019. Revenue is a sales for the company, and their revenue looks good. It grows every year, so they're moving in the right direction. Their net profit margins are really volatile. It's only 6% in 2016, then jumps up to 20% in 2018, then goes to negative in 2019. Net profit margin is net income divided by revenue. It's how well you convert revenue into profit. And in 2018, they converted 20% of their revenue into profit, which means 80% went towards expenses. That's a pretty good net profit margin. But in the other years, it's not nearly as good. 2017 is pretty good. Let's look at a financial statement to see why they have so many negatives. In 2019, they had negative $115 million of net income. Let's look at the income statement. The top line of the income statement is annual revenue. That's $668 million. Below that is cost of revenue. That includes all the direct costs the company spent in order to generate its revenue. That was $331 million. An example of cost of revenue is the payroll for the workers on the front line. Gross profit is revenue minus cost of revenue. That's $337 million. It is good to look at every number on the income statement as a percent of revenue to see if the company is becoming more or less efficient. They have operating expenses of $47 million. Operating expenses are the expenses that are not directly tied to making the products. Examples are marketing expenses and the payroll for support functions like accounting or human resources. Operating income is gross profit minus operating expense. That's $289 million. If a company has negative operating income for a long stretch of time, it will eventually go out of business. Below that is the interest they pay on their debt and the interest they receive on their investments. You want to make sure this number is less than operating income, because if it's not, that means the company will need to take on more debt in order to run its day-to-day operations. Below that is other. That's here because some companies generate money or lose money outside of their day-to-day operations. Examples are when a company writes down the value of its assets. Another example is when a company sells part of its business. What really stood out in 2019 was this $162 million asset impairment. If this wasn't here, they'd have almost $50 million of profit in 2019. You can only get so much information from Yahoo Finance, so I found this on the 10K. It mentions the $162 million impairment was due to 6 steam turbine vessels. Apparently, the value of these vessels was worth a lot less than the balance sheet indicated, so they had to write it down on the balance sheet and pass it through as a loss onto the income statement. An asset is impaired if its market value is less than the value on the balance sheet. Accounts receivable and goodwill are just two examples of assets a company impairs. This is another one. The balance sheet is a snapshot representing what the company owes and owns. So the numbers should be as accurate as possible. If the numbers are overstated, it can be misleading for investors. To give you an example, say you purchased a building last year for $10 million, and this year the value of the building was $6 million due to a really weak real estate market. You would have to reduce the value of the building on the balance sheet from $10 million to $6 million. You would also have to pass through a $4 million loss onto the income statement. The $4 million loss is a non-cash item for this year's financials because you paid for the building last year, and the cash was reflected in last year's financials. Since this is a non-cash item, you would have to add back the $4 million on the cash flow from operations section of the cash flow statement. The result of this impairment reduces your net income, which reduces your earnings per share, giving you a worse PE ratio. It also reduces the assets on your balance sheet. It can negatively affect some of the company's ratios and metrics. It is good to see the loss was not because the company is not profitable running its day-to-day operations. The loss was mainly due to this impairment. Generally, large impairments are uncommon, but if a company was continuously passing through large impairment losses, this would be a major red flag. The assets are the value of the company, so if a company is always reducing its assets, it's like deceiving investors by providing an overstated balance sheet when they initially invested in the company. Let me show you the $162 million impairment on the cash flow statement. So on the cash flow statement, we have to add back the $162 million because it was a non-cash item. To calculate cash flow from operations, it starts with net income, which was negative. Then it adds back the non-cash items from the income statement. It also adjusts for working capital. So the company did have a positive $317 million of operating cash flow. The reason they had negative free cash flow in 2019 was because of this large investment in capital expenditures. They invested almost $500 million in CapEx. Same thing for 2016 and 2018. They had positive operating cash flow, but their investment into their business brought down their free cash flow. Free cash flow is cash flow from operations minus capital expenditures. The reason they had positive free cash flow in 2017 was because of their capital expenditures were so low that year. CapEx are investments in property, plant, and equipment. The entire amount is recorded in the cash flow from investing section in the year the asset was purchased. CapEx is capitalized, which means it is recorded as an asset on the balance sheet. It is depreciated over its useful life, so each year, part of the value of the asset is deducted from the balance sheet and passed through onto the income statement as an expense, so it brings down your net income. CapEx is generally considered a positive thing since the company is investing in their operation to grow it. When analyzing a company, you should consider two factors. The first one, will this item provide the company with a good return on investment? And the second one, what is the opportunity cost? Meaning, would the company be better off if the cash was used for something else? Let's look at a capital structure. $3.1 billion of debt, $700 million of equity. The interest rate they pay in their debt is 5.79%. This company doesn't pay taxes because it's an MLP. In order to qualify to become a master limited partnership, the business must receive 90% of its revenue from natural resources or real estate. This company receives its revenue from natural resources. And they're really leveraged. 82% of the capital structure is debt, which means 18% is equity. Cost of equity is 12.3%, and to figure out cost of equity, we use the capital asset pricing model. And part of the CAPM formula is the beta, and they have a low beta, 1.3. Beta is a measure of a stock's volatility in relation to the overall market. The S&P 500 has a beta of 1. This stock has a beta of 1.3. So if the S&P goes up 1%, this stock should on average go up 1.3%. And if the S&P goes down 1%, this stock should go down around 1.3%. Beta is calculated using regression analysis. Regression analysis allows you to examine the relationship between two or more variables. Beta is systematic risk related to the market, like interest rate changes, policy changes, wars, etc. Systematic risk cannot be diversified away. Unsystematic risk is the risk of an individual company, which can be diversified away by adding more companies to your portfolio. And their WACC is 6.96%, which is a blend of the cost of debt and cost of equity. The WACC is a discount rate companies use when they want to take on new projects. For example, if a new project came along that costs this company $1 million up front, and the project would generate $100,000 of profit each year for the next 20 years, the company would discount those 20 years of cash flows back to today's dollars using the weighted average cost of capital. If the present value of the future cash flows equaled $1.4 million, the company would take on the project. Since it costs them $1 million, they would make a $400,000 profit. But if the present value of the 20 years of cash flows equaled $800,000, then the company would not take on a project. Since it cost them $1 million, they would be losing $200,000. You only want to take on projects that add value to the company. The WACC is a discount rate we are going to apply to the future cash flows for this model. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $869 million. We divide that by 95 million shares, and we get a calculated stock price of $9.14. They're trading at $2.85, so they're trading at a 69% discount. It's a really strong buy according to the model. Simply Wall Street is a lot higher. They're at $25.90 a share, so they're saying the stock is 89% undervalued. Simply Wall Street gets its valuation from the average analyst estimate. It was really hard to value this company with so many negatives. The easiest companies to value are the companies that report positive, consistent financials. Let's see where the stock has been trading at the past few years and look at their previous dividend payments. The stock price was over $20 a couple of years ago, but it's been coming down quite a bit. So if you have faith in this company and this industry, this could be a great value, this stock. Their dividend payments were all over the place. They usually paid around 14 or 15 cents a share. They dropped it a lot recently to 5 cents a share. This makes a lot of sense because their stock prices come down, plus they do need to conserve cash. Because if you invest in this company, the worst situation would be for them to go bankrupt. You want them to stay in business so they can pay you a big dividend and the stock can appreciate in the future. You don't want them to go away today. Their dividend yield is currently 7.22%, which is a lot lower than the average oil and gas midstream company. Dividend yield is annual dividend over stock price. So as the stock price goes up, the dividend yield goes down. And as the stock price goes down, the dividend yield goes up. It is good to remember that a company's financial performance is not 100% correlated to the stock price. It can help or hurt the stock price. The only thing that is directly correlated to the stock price is supply and demand of the market. The stock price will go up if more people want to buy a stock. The stock price will go down if more people want to sell a stock. It is possible for a company to report great financials and its stock price keeps going down. It is also possible for a company to report weak financials and its stock price keeps going up. The market is forward thinking. Part of investing in the stock market is understanding market sentiment and investor psychology, which can be the hardest things to do. Let's look at the financial ratios. They have a negative PE. The median for the market is 16.0. The average is 17.8. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They had negative net income due to that large impairment, so they have negative PE. We can't look at this ratio. They have a great price to sales ratio. The median is 2.0. The average is 4.7. Price to sales is stock price over sales per share. To calculate sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 0.4, so investors are paying 40 cents for $1 revenue. They have a really good price to book ratio also. The median is 2.3. The average is 4.9. Price to book is stock price over book value per share. To calculate book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 0.4, so investors are paying 40 cents for $1 book value. Equity is total assets minus total liabilities on a balance sheet. They have a weak interest coverage ratio. The median is 4.0. The average is 12.9. Interest coverage ratio is EBIT over interest expense. I like to see above 2. They're at 1.6. So they can cover their interest payments, just not a lot left over. EBIT is earnings before interest and taxes, also called operating income on the income statement. Negative ROE, the median is 12%, the average is 13%. ROE is net income over equity. I like to see above 20%. They're negative 17% because they have negative net income. A weak current ratio, the median is 1.3, the average is 1.8. Current ratio is current assets over current liabilities. I like to see between 1.2 and 2. They're at 0.7, so they cannot cover the current liabilities. Current assets are assets that can be liquidated into cash within 12 months. Examples are cash, accounts receivables, and inventory. Current liabilities are debts and payables that are due within 12 months. Examples are accounts payable and current debt. The best way to look at ratios to compare them to similar companies, I've done videos on 30 oil and gas midstream companies, and GasLog is right here. And if GasLog has a number in red, they're worse than the average. Average is down here. If they have a number in green, they're better than the average. So they're worse than average in PE because they're negative due to that impairment. But if they didn't have that impairment, it probably would be okay. They're doing much better than average in price to sales and price to book. They're struggling in current ratio, negative ROE. They're a bit higher in debt at 82%. Much smaller in market cap. They're one of the smallest companies in this list. And they pay a lower than average dividend yield. So to summarize, I do have them trading at a 69% discount because their stock price has come down so much, so it does look like a good buy. Their ratios are weak and their financials are a bit spotty. Let me know what you think. Give this video a like, subscribe, or comment below. I respond to all comments. Also, if you'd like to do a private Zoom session with me, receive a custom valuation, or support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.